Hello, everybody, and welcome to module number 5. We are continuing our coverage, of the financial statements, and now we're going to be looking at the income statement. And in particular, this module will focus on the format of the income statement, the purpose of the income statement, and discontinued operations, which will be a new sort of extension of what you've seen before. Also, the multi-step income statement will be a new format that you will have to know. Most intro to financial courses stop at the simple single step multi-statements, and those are not very useful or prevalent in practice. And we'll talk about why it's not very useful and why the multi-step is much more relevant to users of financial information. And again, remember, we're always going to be reaching back to Chapter 1 and talking about the characteristics that make these things more useful and better information for the public, because remember, that's what we're trying to do with financial reporting. So to start off with, what is the usefulness of the income statement? The income statement provides present and future performance evaluation. And again, it's very important that we have that future aspect of it. Remember, the future interpretations or extrapolations that you can make are what make the information relevant. If you recall, relevant information helps us make a difference in a decision that we're trying to make about a company. And one of the items under relevance is that it has predictive value. And so that's something that's really important with the income statement in particular, because we want our earnings to have predictive value. And we'll talk a little bit more about that when we talk about the quality of earnings. The income statement also helps us determine the risk and uncertainty of achieving future cash flows. Now, that might seem a little bit interesting, given that the income statement is, in actuality, an accrual-based statement, right? Why is it an accrual-based statement? Because net income isn't just cash. Remember, net income encompasses all of those adjusting entries that we make, all of those deferrals, all of those accruals, and so it is in fact an accrual-based statement. Yet an accrual-based statement still helps us determine future cash flows. And in fact, interestingly enough, research has been done that shows that present-day net income, present-day earnings, allow us to predict future cash flows to a greater degree and with greater accuracy than present-day cash flows. And I know that's not very it's kind of counterintuitive, but again, that's why we use the accrual-based system of accounting. When we're looking at those future cash flows, the format of the income statement itself lends to dissecting temporary versus persistent income components. So what I mean by that is that every earnings figure will have some items that will continue and be highly correlated in future earnings, whereas there will be other components of that income and earnings figure that will not be highly correlated to future earnings and will just be a temporary phenomenon in the earnings stream. But the format of the income statement helps us figure that out. Items are going to be listed in order of expected persistence in streams of future income. And so this, again, is the hallmark of a multi-step income statement. In a single-step statement, you just combine all revenues together, all expenses together, and then net the two in order to get to net income. Well, in this case, we're going to have a very specific ordering of our revenue, more so of our expenses. And you'll see exactly how that fits into this formatting of helping investors disentangle temporary versus persistent income components. Okay. Some of the classic ratio analysis we apply in the income statement, it just involves taking the net income number and relating it to balance sheet totals. So, for example, the return on equity represents the profit that's earned on investors' contributions to the firm. So what we do then is just divide net income by average shareholders' equity. And that tells us, hey, well, there's this amount of a return. And as with all ratios, there can be many small alterations that go into these calculations. So for example, you could back out preferred dividends from net income and preferred stock from shareholders' equity, because preferred stockholders are not residual claimants. That is, they get paid before common stockholders. And so they're actually kind of this weird hybrid class that isn't quite debt, isn't quite equity. And, I'll talk a lot about that in Intermediate 2 when we talk about equity. But for now, just, understand that if you're really trying to get the return on equity to common holders, you would back out preferred stock. And again, these alterations are all fair play as long as they're logical, as long as they're rational. So for example, I wouldn't back out preferred dividends if I didn't also back out preferred stock from shareholders' equity, because if you're going to take it out, if you're going to take the preferred dividends out of net income, then you might as well take the preferred stuff out of shareholders' equity as well if you're just removing all preferred items. And again, also remember that as we talked about in the balance sheet chapter, you can't really just take these ratios prima facie. You really have to set a context to them. You have to think about the industry that the firm is operating in, and also the macroeconomic conditions that are prevalent at the time, and whether there's a trend that's going on that you should take into account. So don't ever look at these things in isolation. The other sort of profitability measure we can use with net income is by looking at the return on assets. And again, this is a pretty simple calculation. It's just net income divided by your average total assets. And so it's exactly the same, except that rather than looking at how we take dollars that are invested into the firm and turn them into net income, here we're taking the assets that we use in the firm and how they generate net income. Times interest earned or the interest coverage ratio is similar, except that it looks at income statement components in isolation rather than looking at an income statement component as related to balance sheet components. The time interest earned ratio is earnings before interest and taxes divided by interest expense. So earnings before interest and taxes, EBIT, divided by interest expense for the period. It just represents then the ability of the company to cover its outstanding debt obligations, right? Because what we would see then is if this number is less than 1, then their earnings are not covering even interest expense one time, right? If their EBIT was twice of what interest expense was, then then that firm would be able to cover all of its interest expense 2 times over. And so that's why we say the times interest earned. If it's 4, then they can cover their interest expense 4 times over with their earnings before interest and taxes. And that brings up an interesting sort of side note here. EBIT, and also there's another one, EBITDA, earnings before interest and taxes, earnings before interest, taxes, and amortization. These are earnings numbers that are used in financial statement analysis. And the idea is they're taking out components of earnings that do not relate in the analyst's eyes to operations. So this gives a different view of the earnings of the firm. And whether or not this is something that you want to perform, it just varies from firm to firm. And some people swear by these, and some people would be a little bit more cautious about them. They do they do definitely get more into the idea of, well, how is the firm handling its operating expenses versus items like interest, taxes, and amortization, which are all fixed expenses that don't relate to operations. And we'll talk a little more about this when we look at the multi-step on the next page. The limitations of the income statement are somewhat similar to what we've seen before in the balance sheet. Items that cannot be measured reliably by US dollars are not reported. Income numbers are affected by the accounting method used. So again, we have issues with estimations, and income statement numbers involve judgment and estimates. So of course, you could think about a lot of issues that arise here: depreciation expense, bad debt expense. There are a few ways of recording bad debt expense. We're going to look at different methods of recording receivables and purchases, called the gross method and the net method. So we'll expand on this idea that there could be a lot of alterations to how you're reporting income on the statement based just upon how you choose to estimate, or the accounting method you choose to enact in certain significant accounting policies. And again, that's why when we have the footnotes to the financial statements, looking at that footnote about the accounting policies of the firm, significant accounting policies, is very important so that you understand what's going on and how these numbers are affected by the methods that management chooses. Earnings quality is very simply just the ability of current earnings to predict future earnings. So again, we have this sort of predictive relevance of the earnings number, right? The ability to predict future earnings. In most cases, what managers and also investors want are smooth earnings trends over time, rather than volatile spikes in profits and losses year over year. So, the idea is that if we have a graph, right, and this is time on the x-axis, and we have net income on the y-axis, that over time what we're going to want to see is something that looks very nice and smooth. It just trends upward over time, obviously. What we don't want to see is earnings here at this time period, and then they fall, and then they shoot up, and then they fall again, and they shoot up and they fall. And this is sort of, like, think of it as an investor heart attack, right? You're just all over the place. Buy, sell, buy, sell. So that sort of unpredictability is not what we see or what we want to see with earnings. It induces a lot of shocks into the markets. Smooth earnings are more predictable than earnings that are volatile, right? Standing here on this line, after a few observations, you can basically say, look, it's trending, and it's trending at a very nice, even slope over time. Whereas over here, there's no derivative because there's sharp turns. And so the derivative for these peaks and valleys won't exist. You're not getting any sense of how net income is changing over time. You could sort of draw a trend line. Oh yeah, sure. But then, on your trend line, you have a huge error at any of these times. Well, that's not a huge error, but that is. Okay. So you get the idea. So the idea is that we want 3 quarters to report, $14, $16, and $19 of income rather than 24 or 5, then 20. Even though cumulatively, if you add this up and that up, they're the same amounts. So the retained earnings, as long as the dividends were the same, that they would be the same over time. Still, it's not as desirable. We want the smooth trajectory of earnings. Earnings management, and I'm sure this is something that you've heard before, I hope you've heard before. Earnings management, that is when managers attempt to bias earnings either negatively or positively. Either method will negatively impact earnings quality when they attempt to accelerate the recognition of revenues or defer the recognition of expenses in order to meet earnings targets. And I'll talk a little bit more about that in class. What are earnings targets? Well, earnings targets are, for now, we can just call them analyst forecasts or prior period earnings. You know, your goal is to always post a small gain over prior period earnings, but more so it's the analyst forecasts that the managers tend to game with. That once the analyst forecast is set, it's sort of the manager's duty, if you will, to meet that forecast come hell or high water. When we're talking about accelerating the recognition of revenues or deferring the recognition of expenses, right, we're talking about inflating earnings. So we're borrowing revenues from the future time period or deferring this period's expenses into the future. That would be in order to meet a present day earnings target. Accelerating the revenues will increase the period income. Deferring the expenses increases also current period income. So the reason why we're able to do this, or the reason why managers are able to do this, is because revenues and expenses are not tied to the cash flows in a period. Hence, there's room even within GAAP, so it's not fraudulent. If you're within GAAP, you can still manage earnings. You can still be biasing your earnings even within GAAP. You don't have to become fraudulent in order to meet these goals. So you have to be very aware of this as an auditor, and challenge it when you see it if you think that this is a biased move, because one of the essential qualities of reporting relevant or useful information is that it should be faithfully representative, which means that it's free from bias. Now, a type of earnings management that's not as often thought of by students is that we could be accelerating expenses, that is bringing future expenses into the current period, or deferring revenues. And this is an idea of establishing a cookie jar of reserves for future periods. So like I said, this is a less obvious form of earnings management because they are both decreasing current period income. We are accelerating expenses into this period or deferring revenues. But the reason why a manager would do this is that you're creating a stash of future profits, right? If you, for example, think of it in your own life. If you had, I don't know, you had an unexpected windfall of $30,000, right? Maybe, unfortunately, one of your aunts passes and you're left $30,000 from their inheritance. After you pay taxes and all that, it won't be as that much, but we'll just ignore taxes. So that $30,000, you're thinking, wow, I can go ahead and just pay all my mortgage payments for the next year. So I'm going to go ahead and pay all those this year. Well, you're spending more money in this year, but then you don't have to pay your mortgage next year. So, accelerating earnings doesn't seem like a very keen step because it lowers your current period net income, but in the future, then you have a much rosier picture. You can go take that vacation because you're not paying your mortgage next year, right? And the same idea, like maybe you don't want to spend that $30,000. Maybe you just want to stash it and not even think about it. Well, then next year you'll have that $30,000 if you defer that revenue or defer that inheritance. Okay, so again, we'll talk more about this in class. I'll kind of walk you through an example and talk about the whole game between managers and analysts, because it really does form a very incentivizing scenario for managers to act not in the interests of dutiful and faithfully representative accounting information. All right, so here's an example. Now we're moving into the multi-step income statement. So it's a rather interesting and somewhat complex item. There's this, you would never ever see one this detail oriented on a company's financial statements. We'll look at a few in class real examples, and I'll show you how they look. But this is sort of just giving you the most complex that it could be. So, of course, the income statement is a period statement. It's not as, for example, the balance sheet, which the balance sheet is always as a specific day. It's for a period ending. It could be a quarter, it could be a month, it could be a year, but you have to be specific about what we're capturing with this information. It always starts off with net sales, and we'll talk about what net sales are as we kind of move through more topics, we'll get an appreciation. For now, we can say sales less, sales discounts, sales returns. But again, we'll talk more specifically what those two items are in Chapter 7. We subtract cost of goods sold if it is an expense of the company. Now, cost of goods sold will only be there for retailers, wholesalers, manufacturers, firms that are in the business of offering goods, right? Because if you don't have goods, then how do you have the cost of goods, right? So for service firms, we don't have cost of goods sold. Again, some companies get a little funny with it, and they'll say the cost of revenues. Well, honestly, the cost of revenues are probably going to be more so operating expenses. But anyway, so when we have cost of goods sold, then we have a gross margin on sales. Another name for this is gross profit. And this is our first stop on the income statement that gives us a sort of relevant subtotal, okay? It's something to examine, right? How is our markup working? How much are we able to sell a product over the cost of that product? And again, this is going to vary industry by industry if you think about it. Some industries have very small gross profit and they rely on turning over lots of inventory to make their profit. Some industries, on the other hand, have a huge gross profit and they don't have that high volume of sales, and so they have very few sales, but each sale contributes greatly to the gross profit. So again, it's sort of industry and what goods we're talking about, right? After we figure out the gross profit, the next step is to look at operating expenses, and operating expenses are those recurring expenses that we're going to see time and time again. Remember that when we're talking about the income statement, there is a general trend on the income statement from most persistent to least persistent. Okay, so you're going to be moving from items that come time and time again, i.e. sales, i.e. cost of goods sales. Then you're going to see your recurring expenses, your operating expenses, selling, general, administrative expenses. What goes into that? You can tuck any number of items in here. Basically, the best way to say it is what goes in this, anything that doesn't go below this, right? So we'll talk more about that. Income from operations, this is our next big subtotal, income from operations. And this is basically, for most firms, this is your EBIT. Because the interest and the taxes fall below down here. So when you're talking about EBIT, yes, it is literally earnings before interest and taxes. However, it will also sometimes be construed as just operating income, income from operations. Right? After this, we have a large section, and it says other revenues and gains, other expenses and losses. Really what we could paraphrase all of these items as are non-operating income. So these are the non-recurring items. Items that are less likely to occur. And again, remember, most persistent to least persistent. So now we're here. These were recurring. These are sort of non-recurring and not part of our operations as a firm, more specifically. But those two things basically go hand in hand. If it's part of your operations as a firm, they're going to recur pretty often. If they're not part of your operations, they'll recur less they'll be less likely to recur in the future. Now, what most companies in the real world will show here is just interest expense net. And that's about all you see. Now, the rest of this stuff can occur, and I will, expect you to understand it and know it. But what we see mostly is interest expense net on real world stuff. But what can go in here? Well, other revenues and gains. Interest could go on there, right? Interest revenue, so that would be when we let someone borrow our money. That wouldn't be income from operations. Dividend revenue, this is revenue from other companies. So we hold the stock of other companies and they pay us a dividend. Gain on the sale of non-current assets, this is when we sell something that is not inventory to us. So again, think of that automobile dealer who is moving locations and decides to sell their headquarters, their operating building. They're not in the business of commercial real estate. They're in the business of moving cars, so that's a gain on the sale. Gains where the transaction is unusual and or infrequent, okay? So maybe there was a, oh goodness, gains are a little bit harder to really encapsulate in this instance. But suppose that there was a gain when the company decided to redeem some of their bonds, and that's not something that companies do a whole lot. And so that would be an unusual or infrequent gain. Unrealized holding gains on trading securities. Now, we talked about trading securities in the balance sheet chapter. Remember, these are the ones that management intends to sell on a regular basis. Well, those unrealized holding gains go in here. And notice we call them a holding gain and they're unrealized. That means that the stock stock that we're holding, the equity security, appreciated and we haven't sold it. So we're just holding on to it, but we still recognize that unrealized holding gain because the value of it appreciated, and so we record the unrealized holding gain, and we also increase the value of that stock. Remember, these trading securities are held on the balance sheet at their market value. So any increase in that value would go to the balance sheet. Other expenses and losses, kind of a reflection of what's up here. Interest expense, interest on bonds would be submitted below operations. Losses on the sale of non-current assets, just symmetric of the gain on the sale. Losses where the transaction is unusual and frequent, so floods, earthquakes, casualty losses there. Unrealized holding losses on trading securities, so same thing as here, except now the stock lost value. We haven't sold it, but we still recognize that loss because we would also adjust the balance sheet value downward. So what happens if we actually sold the trading security? Well, that would be a loss on the sale of that we would recognize in this other revenues and other expenses. Right? So after we deduct all of the non-operating income, then we get income from continuing operations before taxes or simply pre-tax income. So it depends on whether or not you have a discontinued operation. If you have no discontinued operation, then we have pre-tax income, you apply tax expense, and then you just have net income. But if you do have a discontinued operation, you're going to submit it below the line. So now you draw a distinction between, well, this is everything in my business that's continuing, and that's distinct from the piece of the business that I'm actually going to get rid of. So, pretending that we do not have a discontinued operation, this would be pre-tax income. This is tax expense. So a lot of times we'll talk about things being above the line and below the line in accounting, in an income statement, especially in multi-step income statement. Everything above the tax expense line is above the line. Everything below it is below the line. So tax expense is the line. Right. If we do have a discontinued operation, we assess tax expense, and that is the tax expense that arises from combining all of these items, getting a pre-tax number, and applying the tax expense. But our job's not done if we have a discontinued operation. Remember, we're working in order of persistence. Well, if we have a discontinued operation, this is obviously going to be extremely non-persistent, right? These are the pieces of the company that will not be with us in the future, in the near future. Or maybe they're already sold off and therefore they definitely won't be contributing to future income. So we'll talk a lot more in depth about what's going on here, but notice a couple of things. We have a loss or income that resulted from operations, and then we include this net of tax. Well, why do we have to include that? We do have to include it. That is a GAAP rule that we note that this is net of tax, because these items are coming after taxes, right? Tax expense was assessed here. So unless we net tax from these numbers, we won't appropriately account for the income tax expense. Now, if you have a discontinued operation, the final result is net income. Right? Now, the other thing that we need to look at is the earnings per share disclosures. This is another thing that is required on the income statement. And what we want to show is either one item or three items. If you have no discontinued operations, then all you have to submit is net income, right? Which would be this number right here with no discontinued operations. Net income less preferred dividends divided by the average number of common shares outstanding. If you do have discontinued operations, you're going to have to show the results of continuing operations, right? That would be this XX right here. Then you would have to show the effect of the discontinued operations, this one right here, and then you would have to show net income after judging that. And we'll talk about that more as we look at discontinued operations, exactly which numbers you're pulling. So again, I talked about most of this, so I won't really go back through it again. The multi-step income statement shows recurring frequent operations that are separately presented from the non-operating activities, and it allows us to draw interpretations on the persistence of expenses and revenues and future income. And again, we have the before and after tax structure to the income statement. The before, right, what comes before? Well, the operating, the non-operating, and something that came in here, something that's worth noting are just these sort of odd items that you might not really understand when you see them. Restructuring costs, impairment of assets, and goodwill. Impairment of assets and impairment of goodwill, not just goodwill. So, you know, also understand that goes right here. Impairment of assets and the impairment of goodwill. What is a restructuring cost? What is an impairment? All right, well, restructuring costs represent one-time bulk costs made to retool or streamline corporate operations to increase future profitability. So if you need a real-life example, what Sports Authority is doing right now by closing down a lot of its stores would be considered a restructuring cost. They're getting rid of items at a discount. They are probably cutting a lot of their employees and giving them severance. And those costs would represent a restructuring cost. Impairments, you'll talk a lot more about impairments, and we'll talk about them a little bit with discontinued operations, but you'll talk a lot about them when you focus on long-term assets and intermediate too. They are just write-downs to the value of assets because of some forecasted loss in the value of those assets. So for example, when a machine becomes ruined, or maybe there is some drastic, maybe for example, a patent becomes obsolescent or useless because of a new patent that just came out in the market. Well, you would have to say the value of that patent needs to be assessed, right? Maybe it's not worth as much as it used to be because of this new patent. And so you would decrease the value of the patent and recognize a big loss. So that's what an impairment is. And those items, the impairments are a little bit more non-operating, will probably be non-operating, disclosed as non-operating income items. But restructuring costs are typically going to be operating items, or disclosed as operating items. And there's a little bit of variance in this. So, you know, some firms will disclose them as operating, some firms will disclose them as non-operating. So again, there's somewhat of a gray area. They are considered non-recurring, but a lot of firms will put them among operating expenses and then provide a footnote that says, hey, these are not going to persist. So mixed messages, right? And I'll talk a little bit more about this in our live lecture. After you have all the before items, you have tax expense, and then you have the after-tax items. And there can be two types of after-tax items. The discontinued operations, which are included in net income, and then we have other comprehensive income items, which are not included in net income, and we'll discuss those in Module 6. So that's all I'm going to cover in this particular video. We'll pick up in the next video, 5.2, with discontinued operations and talk about how those are calculated and how they are disclosed in the income statement. And I will talk to you then. Thank you very much.